Our afternoon keynote speaker, Thomas Barkin, head of the Federal Reserve Bank of Richmond, is joining us virtually today. I'm sorry to have learned yesterday or the day before to have learned that Tom needed to attend a funeral today, but I'm so grateful that he can still be with us under these circumstances. There's quite a lot that seems to be looking good in the U.S. economy right now. Household spending is up, as are retail sales. Employers added 500,000 jobs in January, which was more than twice as much as economists predicted. But inflation clearly remains a major challenge. The CPI is up more than 6 percentage points from its level 1 year ago, which is much higher than the Fed's target of 2%. The Fed has pulled some pretty significant policy levers to cool inflation in the past year or so, but it seems likely that there may be more work to do in the months ahead. And Tom is here to shed some light perhaps on where we are and where we might be headed in the economy and with respect to policy. My colleague, Chenzi Zhu, is going to introduce Tom and will moderate a Q&A with him after his address, and then open up some questions from all of you. And that means it's my privilege to introduce Chenzi to you now. Chenzi is a faculty fellow at SIEPR and is also an assistant professor in the finance group at the Stanford Graduate School of Business. Her research focuses on international finance, on banking, on monetary policy, and on trade. And I'm so happy, Chenzi, that you can be here with us today to moderate this session with Tom and to introduce him. So please join me in welcoming Chenzi for this intro.
Thank you. All right, thank you all so much for being here today. It's been a great morning, and I'm looking forward to the rest of the day. So, I am very honored to introduce, as our first keynote speaker of the day, Mr. Tom Barkin, President and CEO of the Federal Reserve Bank of Richmond. Mr. Barkin received his BA, MBA, and JD from Harvard University, but we won't hold that against him here. Prior to his current position at the Richmond Fed, he served as a senior partner, chief risk officer, and CFO at McKinsey. From 2009 to 2014, he was a member of the board of directors at the Federal Reserve Bank of Atlanta, serving as the chairman of that board from 2013 to 2014. He's also been a member of the board of trustees for Emory University and served as a member of the executive committee for the Metro Atlanta Chamber of Commerce. At the Federal Reserve, Mr. Barkin serves on the Open Market Committee on behalf of the Richmond Fed. And in Richmond, he supervises this bank, and he spends much of his time understanding the economic challenges facing the country at large and his district in particular. So recently, he's delivered several speeches and written many articles on the topics of inflation, the labor market, technological disruption. And this work shows his dedication to understanding how we can stabilize and revitalize the economy, especially after the challenges of the pandemic and in the face of the many challenges we have in today's globalized economy. So we're very honored that Tom could join us here today to share his thoughts, and that he's given us the opportunity to have a Q&A with him afterwards. So, thank you. All right.
Thanks, Chenzi. I appreciate that nice introduction, and I appreciate you having me here today. I just want to say I feel terrible about not being with you in person, and I'm so grateful that Mark and his team were willing to work with us so that I could both deliver a eulogy and do this talk. So thank you for doing that. I will promise that my perspectives on the economy have no connection to the eulogy that I just gave, so we've created a distinction there. I think Mark set up pretty well what I want to talk about, which is, one favorite Fed buzzword is data dependence, which of course means we adjust our policy based on what we learn from incoming data. That sounds sensible, but it's not easy. After all, the prints we get, the data we see, comes in with about a month's delay and is often revised multiple times. So what I try to do in my job is to spend my time outside of our building, which is quite nice in downtown Richmond. It's quite literally an ivory tower. And I try to learn by gathering information real time from businesses, from community organizations, and from groups like SIEPR. Now, if you're following the economy closely, you know the data recently has been pretty confusing. So I thought what I'd actually just do today is talk about how I'm seeing the data, and the economy and what the implications are then for inflation and for policy. I'll say in advance, these are my views and not those of anybody else at the Federal Reserve. So if you were looking at data just a few weeks ago, the story seemed pretty clear and pretty consistent for multiple months. Demand was softening, the labor market was cooling, inflation was settling. People were actually starting to imagine that there really was such a thing as a soft landing. But if you look at the data in January, the stuff that's come in over the last 3 weeks, the story it tells is very different. And Mark said some of this. Consumer spending, job growth, inflation have all accelerated. So the question is January an aberration, or is the economy actually stronger than we thought? And I'll take it in turn. I'll start with demand. So just a couple stats. In January, real consumer spending had the largest monthly increase since March 2021, which you remember was opening up after the pandemic. It was up 1.1% in a month. You could multiply that by 12 to get the annualized number. Real disposable income jumped 1.4% in January as wages and Social Security increases came online. If you look at real-time information from credit card companies, it'll confirm that consumers spent freely in January. So I see the jump in January spending as real, but I'll say I doubt it's as large as it was portrayed or that it's sustainable. And why do I say that? The weather's been unseasonably warm. I realize I'm saying that to people in California, but in the rest of the country, the weather's been unseasonably warm. And that likely has goosed spending. It seems clear that the holiday season, now that you've got Prime Day in October and gift cards stretching into January, have now stretched to 4 months from 2. If you look at retail sales over the 4 months, October to January, they grew at only a 2.6% annual rate. And so I see that sales growth in January as significantly as a payback for a weak December. And finally, all this data is seasonally adjusted. And I do have to wonder whether the fact that we had COVID outbreaks in the last 2 Januaries didn't amplify the strength of this January. So on demand, I think it was strong in January, but I'm seeing it cool down. On the labor market, seasonal adjustments also matter. We saw a huge job number in January, more than 500,000 added. But again, these seasonal adjustments are worth digging into. Normally, employment drops by about 2.9 million in January because holiday hiring is reversed. This year, employment dropped only 2.5 million. So they do the adjustment, and it dropped 400,000 less than it normally drops, 400,000 fewer than it normally drops. And so you get the 500,000 growth number. So I guess I just asked the question, is it likely that in today's labor market, employers were just more likely to shed workers than in previous years? That makes a lot of sense to me. And that means that I'm expecting that there'll be less make-up hiring in the coming months than you might otherwise expect. All that said, the labor market is clearly tight. The unemployment rate is 3.4%. That's a 54-year low. The last time it was lower was 1951. Employers tell me they're not as desperate as they were a year ago, but it's still difficult to find workers. And I hear that particularly for skilled trades like nursing or construction or auto mechanics. There have been a number of layoff announcements recently, particularly around you guys. But I would note they've been disproportionately professionals. I know I'm hitting close to home when I do that. Professionals rather than frontline workers. And I'll just say repotting is never easy, but just remember that unemployment for those with a college degree is actually quite low. It runs in the 1.9 to 2% range. And that suggests that whatever labor market adjustments are required may come with less of a price than prior downturns. If your image of a recession is the Great Recession, with the painful Rust Belt construction and manufacturing challenges, we may be looking at something different this time. So with that, let's talk about inflation. After several months on a downward path, inflation accelerated in January, both in the month-to-month numbers and the year-to-year numbers. And we'd seen some pretty encouraging fourth quarter numbers that were revised upwards. So again, the question is this just a blip on a smooth path down to our 2% target? Or is this a signal that we have a long way to go? And this question is an important one for policy, so I'm going to spend some time on it. Now, 2 views here. Some believe this is going to happen pretty quickly. And until a recent adjustment over the last couple of weeks, that's where markets were. And ahead of the most recent inflation data, the average respondent in the survey of professional forecasters projected that inflation would be 2.6% by the fourth quarter of this year. So why might one expect a quick return to normal? Well, you might come back to what's now become a dirty word, the word transitory. And a reminder that transitory has two different definitions. One is brief, and the second is not permanent. Inflation has clearly not been brief, but maybe getting to the other side just takes time. I mean, after all, supply chain issues are clearly easing. Most people are back to work. Transportation costs have come down. Broad commodity price inflation is back to pre-pandemic levels, and fiscal stimulus is waning. If you think that inflation is largely physical or fiscal driven, then it could decline pretty quickly as we return to normal. Or you might hang your hat on the fact that the Fed's rate hikes and balance sheet reductions are still in their early days. You might think they've been sufficient, but they're just going to take effect with a lag, with a delay. And that's because our moves impact financial conditions pretty quickly, but take time to work their way through the real economy. If we've hiked enough, then as we make our way through that lag, maybe inflation would quickly fall. After all, liquidity is leaving the system, the housing boom has subsided, demand is likely normalizing, and wages are settling. Or you could even believe the Fed is going to do even more than we've signaled to date and will clamp down in an even more aggressive manner, risking a deep recession to snap inflation down quickly. And Paul Volcker proved we have this power should we want to use it. Now, to be clear, I've not seen anyone suggest inflation has yet become the problem that he faced in the early 80s. Now, by this point, you've probably figured out that I don't think normalization will be quite this easy, and think that returning prices to the stability of the last 30 years will likely take a lot more time and a lot more effort. And I think this view is in step with the actions that the Open Market Committee has taken so far, and with the most recent summary of economic projections that showed inflation not returning to 2% until 2025. So why do I see this fight lasting longer? Partly because a number of the dislocations we saw in the pandemic are still around. There's still $1 trillion in excess savings that's funding consumption. We're still seeing continuing fiscal outlays like the infrastructure bill. New auto inventories and houses for sale remain near historic lows, which supports prices in those sectors. There's still supply chain challenges in sectors like switchgears and cabinets. The labor market remains historically tight, as I said earlier. And China's reopening and events in Ukraine may well also pressure commodity prices. In addition, I'm seeing inflationary pressure coming from firms and workers who are trying to recapture lost ground. In a number of sectors, like healthcare, utilities, food, I hear from contacts whose margins have compressed and who feel the need to restore them through further price increases. And presumably, they're motivated to move faster than those sectors whose margins improved during COVID and who may eventually be pushed by their customers to give on price. Similarly, workers whose real wages fell are still pressing to catch up. I've heard of many larger than normal increases in the end-of-year merit process. You might also look at inflation expectations. While they remain well anchored on average, there's been enough movement under the surface to warrant caution. The Michigan Survey of Consumers has seen the one-year median expected inflation rate fall from its pandemic high, 5.4%, to 4.1% in the most recent reading. But this masks an increase in the range of responses. And by one measure, the range of responses is at levels last seen in 1982. Some of the research on the 70s found that an increase in the standard deviation of inflation expectations preceded high and unanchored inflation expectations. So it's worth remembering that even with Volcker's aggressive approach, which many of us remember from the early 80s, it took years to corral inflation back into a narrow range. And his era was certainly different. We didn't have an inflation target. Inflation was much higher. Expectations were much more unanchored. But it is interesting to remember that in his era, it took until 1983 to get inflation below 4%, and 1986 to get it to 2%. Remember, he started his actions in 1979. But most fundamentally, the way I think about it is this. 2 years of high inflation and ubiquitous conversation about inflation must have had an impact on how firms behave. For a generation, business leaders have learned you can't count on pricing to drive profits. Large retailers like Walmart or Home Depot resisted every price increase with fervor, and they had options to redirect their business to lower-cost suppliers overseas. Consumers found they had power as well through price shopping, which was enabled by e-commerce. The Fed had earned real credibility for our ability to deliver stable prices. You could say we played a role in every wage negotiation and every price negotiation. But now pricing is back in play. And every business knows that the impact of pricing is considerable because if you're successful, it flows straight to the bottom line. A number of businesses have found inelasticity they hadn't had the courage to test for previously, and they're looking to find more. Supply chain challenges have worn down purchasing departments. They now seem more willing to accept increases at a time when volatility has made supplier cost structures more opaque and availability more important. In most companies, there's this continual tug of war between a finance team that sees price as the clearest path to profits and a sales team that fears loss of business, loss of market share, and loss of incentives. In a world of very anchored prices, sales won that battle for years, but finance is winning more and more now, and I think will continue to keep pressure on prices until customers and competitors reassert themselves. Now, monetary policy plays an important role here. As you know, the Fed has raised rates and reduced our balance sheet aggressively in the last year in an effort to bring demand and supply back into balance. We are seeing impact. Inflation is likely past peak, but I think it will still take time for inflation to return to our target, and as a consequence, believe we still have work to do. That's why we forecasted additional rate increases and made clear that we don't anticipate further rate cuts this year. That's in the SEP. I want to be clear, the Fed's objective isn't to hurt the economy. It's to reduce inflation. And if there's one thing that we've relearned, and I think painfully over the last 2 years, it's that everybody hates inflation. They hate inflation because it creates uncertainty. Prices rise unevenly, and it becomes unclear when to spend, when to save, or where to invest. They hate inflation because it's exhausting. It takes effort to shop around for better prices or to handle complaints from unhappy customers. And they hate inflation because it just feels unfair. If your boss gives you a wage increase, you feel like you've finally been recognized, and then it feels arbitrarily taken away at the gas pump. The Fed is the organization charged with fighting inflation, and I hope you think we've made our resolve clear. And I just say, if you read anything about the 70s, the experience is compelling. If you back off at inflation too soon, it comes back even stronger, which requires the Fed to do even more, which means you have even more damage. So I certainly would like to avoid that. That said, with real rates having risen dramatically in the last year and now positive across the curve, it does make sense to me to move more deliberately than we did last year. And here's where I come back to data dependence, where I started. If I'm right and inflation persists, we can react by raising rates further. And of course, I'd be happy to be wrong. We would all like inflation to fall quickly back to target. I'm confident it will in time, but doubtful the process will be quick. But I should close by reminding you that inflation doesn't come from statisticians. It comes from the sum of individual actions. So if any of you in the audience and any of your businesses have a price increase in the works, I want you to feel free to help us all out. And with that, I'm open to any questions, input, comments. Look forward to talking.
Okay. All right, I do see many questions in the audience, but I would take the opportunity as the moderator to start us off. So thank you very much, Tom. So as you've made clear in your remarks, everyone is thinking about inflation. It's our biggest source of macroeconomic uncertainty right now in the US, I would say. But if I take a step back and think back to March 2020 or March 2021, and in particular what the Fed was communicating at that time through, for instance, its dot plots, as well as what Chairman Powell was communicating, inflation really didn't look like it was anywhere on the horizon. So the dot plots from 2020 would say we would have zero short-term interest rates until now or 2024, and they were still projected to be pretty low even in 2021. So I think the question is, obviously a lot has changed. There were lots of supply chain holdups. There was the invasion of Ukraine. There's the Great Resignation. But what were the factors, I guess, in your mind that led us to where we are today, which is the highest rates of inflation that we've seen in a few decades, as well as the highest rates of interest rate increases that the Fed has had to put in place?
It's a great question. I gave a speech on this in September, and I wish I could tell you that it was just perfectly obvious. But here's how I think about it. We've had anchored inflation expectations for decades. During that time, we had all kinds of shocks. On the upside, oil prices spiked, if you remember, in '08, or we shut down the economy at some level after 9/11, or you had the great financial crisis, or you had a lot of monetary stimulus in 2010, 11, and 12. And in each of those cases, the strength of the anchoring of inflation expectations was able to hold up against these shocks. And that's very much consistent with what the theory would say. You'd look through those one-time shocks. Well, what happened in 2020? Well, we had a pandemic, and that led to significantly different shopping behavior, as well as significantly different labor force behavior, both of which ended up with major supply disruption and major demand-supply imbalances. With all the right intent, we put a lot of fiscal stimulus, $6 trillion, it turns out, is a lot of money, and we put a lot of monetary stimulus into the puzzle. And we had a war breakout in Ukraine that fundamentally, torched commodity markets. And I just think the combination of A plus B plus C plus D, fiscal plus monetary plus war in Ukraine plus pandemic era things, and the implications on shopping behavior and labor force actions just overwhelmed the ability of the market to come back to equilibrium quickly. So then we had inflation. And then the question ought to be, I'm sure it is, well, why didn't it just go away quickly, right? And of course I said transitory was a bad word, but that was, I think, the spirit back in the spring of 2021, and perhaps why some of the forecasts were of much more benign monetary policy, because people really did think we don't have chips in cars, and so car prices will come back down once we get chips there. It's now 2 years later, by the way. And so there's been a lot of talk about why did this last, and I really think as I've talked to executives and businesses, they actually say we took no price for the last 10 years. Price was not a lever for the last 10 years. This was not an opportunity for us. And all of a sudden, in a context of widespread supply chain challenges, where everybody just needed the volume and needed it quickly, they had pricing power they hadn't had in years. And once you get that, you don't give that up quickly. Your customers have to convince you not to wield it, or your competitors need to convince you not to wield it. And that's the adjustment process we're going back to this year. You can say the same thing on wages if you wanted to. I mean, merit increases were 3%. That's what they were. And no employee got up and said, why isn't our merit increase 4%? Everyone knew inflation was 2% and real wages were up, and so that's 3%. What's the problem? But all of a sudden, it starts to look like everyone's getting a big increase, so why wouldn't? And so those are dynamics that I just don't think I'll call it the oscillating economy comes back to normal quite that quickly. I just think it takes time.
Yeah. Just a quick follow-up, and then I'll turn it over to the audience. What you've basically highlighted, I think, is the way I often teach this concept of inflation and the importance of inflation expectations to my students. And you've highlighted that both from the producer side as well as in terms of firms setting prices and labor demanding wages, that expectations have changed, and so this has made the Fed's job harder. We also started the talk with this point about data dependence. What data is the Fed looking at now that might be different from what it was looking at before, or is it looking at it differently to get a better handle on these dynamics that maybe it didn't have in 2021?
Yeah, thanks. So the thing that isn't talked about much is that the 10 years before the pandemic, economically, were as stable as any period certainly in memory and maybe in history. GDP ranged between 2% and 3%. Inflation ranged between 1% and 2%. We added jobs in every month after 2010. And so you had this very, very stable situation that all of a sudden became very unstable, first with the pandemic and even today. And so it has certainly broadened the set of things you look at on inflation. On spending, for example. I'm now in the world of weekly tracking credit card sales because it moved so violently, not just up and down, but also from services to goods and goods to services, that trying to keep track of what's actually happening on the demand side on a real-time basis, that's a whole new data set that existed, but wasn't really a fundamental part of what I was looking at, because you'd look at consumer spending and it would be plus or minus the same number month after month after month. On the employment side, I used to just look at the unemployment rate, but participation has been such a massive issue in this environment that you really have to look more broadly and ask the question, who are the people who aren't in the labor force? Why aren't they in the labor force? And to the extent you find out, as we have, that they're people my age, what would it take to get them back in the labor force? I think it's a critical set of issues that goes to the question of whether 3.4% unemployment is just crazy tight, as it seems to be, or 3.4% unemployment is pretty tight, like it seemed to be in 2019. So that's the second set of things. And then, as you would imagine, there's a lot of parsing on inflation. I guess that's what I put it. Again, if you look at the month over month CPI or PCE numbers from 2018 and 2019 when I joined, they range between it increased 0.1 to it increased 0.3. And so you're headed toward 0.1, 0.2, 0.1, 0.2, but there's not a lot of action and digging deep into it. This past month, they increased, core PC increased 0.6. You could multiply it by 12 if you wanted to go down a dark hole. And so you really want to understand what's going on. What is goods, what services? Is there an explanation for it? I keep hearing rents are coming down, but the rent numbers go. So there's been a lot more digging into inflation, I'd say, than in a world of high stability. And part of the reason I wanted to talk today about how I'm seeing the data is I actually think this is one of those periods where the more time you spend with the data, the more you learn, as opposed to just looking at the headline.
Awesome. Thank you. Gentleman in the front in the burgundy blazer, I think.
I just want to say thank you as a equity investor for 50 years. I'm a long-term value investor, and your Chair Powell, in the second paragraph, second sentence of his Jackson Hole speech, had the memorable sentence, "Without price stability, the economy does not work for anyone." And so you guys are holding to that. What we don't want to do is when we started in '64 at 2% inflation, and it went up cyclically, every low was higher than the last low. Every high was higher than the last high, ending up in double digits in 80 or 81. And then the all-timer bad memory, which I remember in 84, the summer of 84, 14% treasury rates, and the year-over-year inflation was 4%. And that's a nightmare. And you guys are doing a great job. Thanks.
Thank you. I didn't hear a question, but I'm going to I'll take the compliment. Well, one thing you said about inflation that is worth just a comment on is it actually hits people in very different ways. And one thing people don't really think about is those with the least money, who are, of course, often hurt the most by unemployment, are also the people also hurt the most by inflation, simply because they spend most of what they make. And so we have a dual mandate. It's unemployment and inflation. As Jay said, if you don't have stable prices, it doesn't work for even the people you're trying to, if you will, keep employed on the employment side. So I just think that's an interesting angle to look at. It's worse for those with the least well off. Both unemployment and inflation are worse for those who are the least well off.
Hi, I don't want to be too much like Dan Aykroyd and Jane Curtin, but sitting next to John, I want to take the polar opposite point of view.
Well, can I have John back again?
So I know that you guys are, on the Fed, are very concerned about the wage price spiral and feel that the only way that that will go down is by unemployment increasing. But we also know a few things. We know that M2 money supply has some bearing on inflation, and that's been coming down. We know that layoffs are beginning to increase, so that a lot of people that were hired during the pandemic, I mean, they're pretty substantial and multiple layoffs, at least on the Silicon Valley companies, for instance, where they were evidently hiring just about anybody because they were afraid they couldn't find employees. So now in those layoffs, they're finding that they're able to actually lay people off pretty painlessly where they really shouldn't have hired them in the first place. So there's going to be more people available. We know that there's a long lag between rate increases, and you guys have already done it to 4.5% faster than ever before. So there's a lag. And so why not? And then you know that you guys are beginning to let the balance sheet run off, $100 billion a month kind of thing. And we don't quite yet know how that's going to work its way through the system with the liquidity and banks. We know that we know that commercial, like office space, people not returning back to office. We know that bankruptcies or companies like Blackstone and Brookfield and so on turning back and walking away from their loans because the rates have risen so high. We know that mortgage rates are at 7%, that has an impact on people buying homes. So lots of impacts are beginning to happen real time today as opposed to retrospectively. So my question is, why not take a pause? I'm not saying start cutting rates or even think about that. Why not say, you know what, we've raised to 4.5, 4.75. I think it's a foregone conclusion you'll probably do another quarter this next time around, so that gets us close to 5. And then say, and now we're not taking a direction one way or the other, but we want to see how this works its way through the system so that you don't have to reverse or don't have to do the thing that breaks the camel's back, and then sorry, we overdid it. Why not just say, without any end in sight, say, we're going to take a pause for a few months, and then we'll see what happens as all of these things kind of work their way out, and we see how it's reflected in month over month over month for a few months without us taking an additional action. And then if it's continuing to go up, you can always resume raising rates. But why even think about cutting rates? I mean, that's not the question. The question is, why not?
That's kind of the question.
The question is, why not take a pause?
Yeah, I got it. I really do want John back now. So let me just say this. I think trying to set policy isn't simple in a world where the data is not clear and there's lots of uncertainty. And so you're always trying to think about the risks on both sides of it. Of course, there's one risk of, raising too quickly and, sending the economy into trauma that doesn't need to happen. And there's also the risk of raising too slowly and, getting behind on inflation and then having to do even more to catch up. So any given policy choice, I think, is trying to balance those two things. If you go back to last year, we started the year with rates at 0 and inflation wasn't settling, it was climbing. And so to me, it made a lot of sense to move as fast as you possibly could without inadvertently, doing something overly damaging. And I think reasonable people could agree. And certainly if you're in the residential housing market, you'll probably happily disagree. But I think for the most part, we've gotten to where we are without too much damage, certainly at that pace. And so at the last meeting, we increased 25 basis points, not 50, not 75. And I've said, publicly, I'm pretty comfortable with the notion of if inflation were to stay elevated, you keep responding. But if inflation, were to linger, you might handle it differently. And that's what I said in my talk today, too. I don't quite understand the case for a pause at this moment, other than I don't believe any of the data. I don't believe inflation rose in a 7% annualized rate last month. I mean, and again, trying to balance those two. The beauty of a shallower rate increase path is if you're wrong, you're not that far wrong. So that's how I think about it. But you and I can agree to differ today, but I have a hypothesis that if 6 months from now, the data comes in the way you think it's going to come in, I'm going to agree with you. And if 6 months from now, the data comes in the way I fear it might, then you're going to agree with me. And so I just don't see that's that big of a spread.
Yes.
Thank you so much. I have a question. The fact that the economy still remains quite resilient, and also the inflation is so persistent in spite of the fastest tightening over the past year, there are different, people in different camps. On one camp seems to be aligned with what you are saying, that they just take time for the monetary policy transmission, right, to take effect. There's another camp basically arguing that maybe our star is much higher than what people are, thinking. We know that currently Fed seems to see that our star is about 2.5%. So when you lift up the Fed fund rate to 4.5%, then it's already restrictive. But what if the R star is actually much higher? And then given that, that means your monetary policy is just not tight enough, not restrictive enough. So, thank you.
Yeah, so first of all, R star, great concept, made perfect sense to me when it was first explained. I then said, well, what's the confidence interval? And the confidence interval of R star is actually like 200 plus basis points. So most people would say, and I think the median in the SIEPR right now is about 2.5%. And to your very good point, that might mean it's 0.5%, but it might mean it's 4.5%. And so you can focus on R star as a concept, but the real question I think you're trying to get to is, do I have rates in restrictive territory? And what I've been looking at is, 3, 6, 12, 24, 5-year, and 10-year rates versus all of the relevant forward inflation expectations. Do I have rates above inflation expectations and on all of those dimensions? And we're there now. And so I've convinced myself that's good evidence that we're in restrictive territory. What kind of gap between rates and R star one needs to bring the economy and inflation back down to normal, though, is another difficult question. And that's back to the prior thing, which is I think you have to feel your way there. There's not a way to model your way there, at least not one that I can real time trust given the confidence intervals.
Actually, I have a follow-up question, which is about exactly how we should define normal. The Fed has been pretty clear that 2% is their inflation target, but given how much the economy is changing structurally, the world's economy is changing, globalization, climate change, many of the topics we're talking about today, why is it the case that 2% should be the right target?
Well, there was a big debate in the 90s about what the target could be. Famously, Janet Yellen and Al Broadus, who's my predecessor's predecessor in Richmond, did, I guess, a Shark Tank proposal in front of the FOMC, and one made the case for one or one the other. I think it's totally legitimate to ask the question about what the right inflation target should be. And there were people who argued for 0 because price stability is price stability, and what about 2%? Feels like stable. Over, I forgot the numbers, 35 years, you'll inflate, by half. Another case could be made for 2%. The case for 2% includes that inflation's mismeasured, and that's a reasonable way to do it. You don't want inflation to go below 0. It gives you a little bit of room. By the way, it's the standard for every country around the globe. Some people do a range or 2 and 2, but it's basically the standard. And importantly, seems like it worked for 30 years. Since that debate in the mid-90s. I think you can make a case for 3%. People have done it. The one thing I don't see a case for 3% now. And what I mean by that is the Fed sets its target at 2%. The Fed's effectiveness is fundamentally driven by its credibility and the conviction that people in the economy have that we will do what it takes to bring inflation down. That's an incredibly important lever in terms of moving inflation in the right direction. And I just think if we sort of looked at our watch and said, this has kind of been tiring and, we're at 3% now, so let's just change the target to 3%. I think the damage to the credibility of the Fed and consequently to one's ability to control inflation would actually lead to the next conversation being, why isn't it 4%, 5%, 6%? So I just think that's a bad rabbit hole to go down. Not that if we got to 2%, when we get to 2% and we have our next review and we can stop and look at what the targets are once we've achieved our target, I think legitimate conversation. But I think if you haven't achieved your target, changing the target doesn't feel quite right.
Makes sense. All right. Was there a hand over here? I thought I saw so many hands and now it's very quiet. Yes, gentleman in the front.
Most measures of financial condition suggest that they're quite a bit looser than they were just 6 months ago, and roughly about the same as they were a year ago before the Fed even started hiking. And if you look back further, let's say the last 5 years, outside of the immediate lockdowns, the immediate post-COVID lockdowns, they're right in the middle of the range. How are we supposed to be thinking about that in light of almost 500 basis points already of Fed hiking? How's the Fed thinking about those numbers? And does that suggest that we should be putting more than a de minimis amount of probability in a world state where the Fed has to hike quite a bit more than what is suggested now?
Yeah, so is one of Ben Bernanke's innovations to make the point that the Fed can be a lot more effective by working with markets rather than against markets. 30 years ago, we didn't even have a press conference or a memo or even an announcement when we changed rates. We just changed them and let people try to figure it out, apparently by the width of Greenspan's briefcase. And so I think I was gratified when we started this hiking cycle that rates moved pretty quickly to send the message that we weren't going to be at zero forever. And that had a quick effect on things like housing and other interest-sensitive sectors. Over the last 4 months, there have been definitely significant periods where a number of those rates have come off that. But if you look right now, I think the 2-year is just, I haven't looked at today's numbers, but it's just under 5. I think this week, the 10-year and the 30-year were both at 4. And so they've all come up significantly from where they were. And I think it's sort of a fool's errand to try to spend all the time trying to micromanage the markets. The markets don't listen anyway. And so I think we can do our best to communicate. I think you're hearing, at least on a traditional statement, a lot more consistent communication from me and my colleagues about the set of things that should matter in terms of that influence. And, if the difference is that the markets are making a different forecast, let's see. If the issue is the markets see a different reaction function, then I think that's more of a problem.
All right, I think we have time for one more question. So if anyone is burning with a question that they, yes.
So a recent Fannie Mae forecast shows CPI in 2023 and 2024 at 2.6 and 2.3, and GDP in 2024 at 1.9. Do you think those numbers are reasonable?
Good question.
Well, I've gotten questions today from people who think they're reasonable and questions from today from people who don't. I think the way one thinks about a forecast starts with this question of what's going to happen to inflation. And if you believe that there'll be a significant drop in inflation relatively quickly due to whatever combination of M2 coming down, supply chains, the lag of policy, the balance sheet, commodity prices coming down, modest recession, whatever, then I think you could imagine with inflation coming down, the Fed doesn't have to do that much more. The economy, you didn't give me, I don't think, a GDP number for 2023, has a modest 23, and then, comes back and has basically an at-trend year in 2024. As I said in my talk, I'm a little less optimistic on inflation. I hope I'm wrong, but I'm a little less optimistic on inflation. And so I think it's going to take longer and more for us to get inflation back under control. But, reasonable people can disagree in terms of that forecast.
Okay. All right. Well, thank you very much, Tom, for speaking for us.